Hello and welcome to Options Guy TV. My name is Brian Overby. I'm the author of The Options Playbook. Today is President's Day and the markets are closed. We are taping this show prior to President's Day, and I want to make it a very simple show in that I just want to add a couple of stocks to our deep in the money call portfolio that we have. So I'm going to look at adding Berkshire Hathaway. And then we're also going to look at a holdings of Berkshire Hathaway, which is Nucor, a steel manufacturer. And because of that, well, recently Nucor has kind of got beaten up. It's been fairly volatile because of tariff news. Tariffs are increasing on steel. They're going up, they're going down. But overall, the tariffs have really helped the U.S. steel industry. So not quite sure where it's going to go next. But the last news headline kind of drove the stock down. Warren Buffett, i.e. Berkshire Hathaway, bought 6.6 million shares recently of Nucor. So kind of showing a little confidence in that, well, in the manufacturing of steel, in that industry as a whole. And so the fact that we got the drawdown means I want to come in and add it to the portfolio so that we can stay diversified. So we're going to start by adding Berkshire Hathaway. Symbol is BARK/B. We're going to do the Class B shares. So the symbol's always kind of a struggle when you're looking at Berkshire Hathaway. But let's run to the Tradier Pro software. And I already have the options chain up for Berkshire Hathaway. And we're going to look at the June expiration. So I'm going to highlight over here all the way over on the right-hand side of the screen. We're looking at the June 18th expiration. It's 125 days away. That's where inside our portfolio, a lot of our option contracts expire at that expiration. So we're going to keep things simple. I like to go out about half a year, about 6 months usually. And I'm obviously buying this option as a substitute for owning the stock outright. And that's why we're putting this portfolio together, is to have longer term positions that we can talk about. So let's get this trade executed on Berkshire Hathaway. The stock right now is at 501.15. They're going to be announcing earnings here shortly. So let's go out to the 70. Let's go down to the 78 delta. We got the June 18th expiration. I always like to confirm that over here. 125 days away. We're looking at, we could do the 81 delta, but the one thing that I do like, and I usually, if I'm like on the cusp between 79 and 80 delta, I would just like to look at the open interest. I prefer to buy the option that has the most open interest at the time that you put the trade on, especially in the deep in the money option contracts, because we're going to kind of struggle with the bid and ask on these contracts. I would normally work the order, but this is a paper trading app. So we're just going to buy the $47.25 option contract, and I'm just going to put it on the asking price. So in this instance, this is a real option contract. We're talking about $4,725 to buy one option. The volatility is not bad at all in Berkshire. The stock has made a strong move up. It's been a solid performer, but ever since Warren Buffett actually retired, the stock has kind of just meandered looking for its next foothold. But obviously the fundamentals, the PE, all the things that are involved in Berkshire Hathaway are very solid across the board. So if we look at a $47 option on a $500 stock, we're only looking to put up about 10% of the full stock price. And we're going to get a 79 delta, or, I'll round it down to 78. That means that if the if the stock goes up 1 point, our option contract should go up by 78 cents. Or if you look at it this way, as opposed to buying 100 shares of stock, where you would have to spend $50,106, and the stock went up one and you would make $100. We're going to look to spend $4,725. And if the stock goes up one, we're going to make $78 because each option contract represents 100 shares. So it's a way to take a position in a larger price underlying stock and get a lot of stock price representation. Now, there's still time premium in these option contracts, and you still got a little bit of headaches that you got to deal with when it comes to these underlyings. But it's an interesting way to manage your risk on an expensive stock without having to put up all the capital to buy the stock outright. So right here we're at, if we look at, I already got the order in, we clicked on it. It's down in the trading ticket down below. I'm going to buy one of the $470 strike call option. Delta is at about 78.20. Well, it's 78.25 right now. Markets are open. They're rocking and rolling. We're taping the show Friday prior to President's Day, prior to February the 16th, 2026. The midpoint is $46.40. I'm just going to hit the ask. Now, I would never do this in a regular portfolio, but I just want to trade the fill. So I'm going to send that to the order status screen, or send it to the paper trading floor. All right, order's already filled because we put it in right at the market. So we just bought one, spent $5,000, 10% of the underlying stock price. Got a lot of good stock price representation, but the maximum we can lose on this trade is 10%. Now, here's the risk parameters. Whenever I do a trade like this, if the market did ever come down to the 470 range, I want to get out. And here's the beautiful thing about the options on the downside is that if the market goes down, delta actually gets smaller, right? Because it becomes an at-the-money option contract. Right now it's at 78. If the at-the-money, the stock's at 500, if the at-the-money option contract, if it happened tomorrow and the stock dropped 30 points and went to 470, well, this would be the at-the-money call option. Guess what it should be trading for? Approximately what the 500 strike is trading for right now, the most at-the-money option contract. So if that happens, so my approach just in general when I see this is I say to myself, well, if I get down, there's two ways that you can look at it. If I get down 50% on the option the deep in the money option that I purchased, well, then I'm going to get out, and I have 10% risk right now. My management would be that I only want to lose 5% on this. And if that does happen, I'll go out and find a different stock, and I'll try to adjust my portfolio. On the upside, I gain deltas as I get deeper and deeper in the money. So we have an 80 delta option contract right now. If you go deeper in the money, they're going to start acting like these options down here. And if the delta ever gets to 1, which means it's acting just like the underlying stock, and look at this, this would be a real expensive option contract, right? $119 option contract to get somewhere close to, well, $128 option contract. If we're right at 1, and that's where it is, it just hit 1 on the delta. We're at $128 option contract, or $12,860 is where that option contract would be at. And when that happens, then I just roll. If I'm correct in my forecast and that eventually happens, and I see the delta get to 1, I'm going to roll back to another 6-month option contract, and I'm going to find another 80 delta. This way I'm taking money off the table. My outlook was correct. I'm going to take some of the profit on the first option contract that I bought, and I'm going to roll and keep my position as long as I'm still bullish in Berkshire Hathaway. So we have a solid plan. On the downside, we can get out at about 50%, or another way to think of it is normally that's going to happen somewhere close to this strike. As time decays, that will change a little bit, right? As we get closer and closer to expiration, that will change a little bit. But if the stock does hit 470, I don't want it to go beyond that. Or if I can say to myself, well, if I lose half of my investment in my deep in the money call option, I'm out. If we get up to the delta to get to 1 or close to 1, I want to buy that back. I want to sell that to close and buy to open a new one. And I want to go back with the same plan again. All along the way, we can decide to sell calls against it if we want to try to generate some option premium above and beyond what capital gains you may get on the option contract. we might do that. And if we turn that into that trade inside the options playbook, I actually like to call that the fig leaf. So we executed that trade. So now let's go look at a holding inside Berkshire Hathaway, which is Nucor Holdings. So the symbol is NUE. And we're going to stay at the same expiration, which is nice because sometimes when you get to the longer term expirations, you don't have as many expirations that are available to you. It just so happens that Nucor also has a June 18th expiration, so we can keep things in order there. We're looking at $185 stock, so it's going to be a little bit cheaper option contract, June 18th. So we can buy a couple of them in this instance. And the biggest difference is it's not that implied volatility. Implied volatility is actually going to be quite a bit higher on Nucor, and it has to do with the news cycle and what's happened with the underlying stock. And I guess I should actually pause for a second and show you this. So here's the reason why I'm fairly interested in Nucor is that we actually did have this nice little climb higher, and then we received the news and we've kind of bounced back down. But as far as the chart is concerned, we have our ducks in a row. You got the 200-day here, you got the 20-day or the 50-day, and you got the 20-day. The stock looks fairly solid. PE ratio isn't ridiculous. It's a little bit inflated because we've had a little bit of a move up to the upside, but not bad overall. So we're going to trust that it's part of the Warren Buffett portfolio. We're going to look for more of a move in the near term, and we're going to I don't know about take advantage, but we're willing to look at this and saying that the news event is a little bit overdone on Nucor, and we're going to look at it as a buying opportunity. So Nucor, 185 is 182. We're down another 5 today, so we'll call 185 will be the most at the money option contract. But we're going to scroll down and we're going to look for, we're in that same expiration in June, highlighting that right here. And we're going to look at the 80 delta. So we're in the same scenario. We could do the 82 and the open interest is 63. We could do 78 delta and the open interest is 233. So that's the one we're going to do. A little bit more open interest. Put it at 320. Send it down here. We're going to do a couple of these. It's $31. We paid $49. So we're right. We're going to go. Let's do 2 of them, though. We could wait and buy one and wait till the end of the week and buy the second one. That's an okay plan too. Dollar cost average into the position. But I'm just going to put this on. We're taping this show. Let's just get the position on, and we can come back and talk about it and manage it at a later date. We're going to use the same outlook that we had for Berkshire Hathaway. If the stock comes down to 160, hits our strike, which is right here on our call option, we're going to do that. We're just going to close it and get out. And you can look at it once again. Here's the most at the money, the 185, and that's actually a little bit out of the money, but that's trading for 15. We're paying 30. Isn't it weird how it always seems to kind of work out? It's about half. If this becomes an at the money option, if the stock goes down to 160, it'll be trading about what the 185 is trading for. And you're looking at, that's about $15. Now, I just want to get out if it gets down to $15, but just be aware that that's the type of move that you're talking about to the downside, to lose about half of your investment in your deep in the money option contract. So the market is, these are wide, and I've talked about this before. Here's the biggest headache about using deep in the money options as a substitute for the stock is the bid-ask spread. You try to work it a little bit. I play with it quite a bit. Start at the midpoint and then give up a nickel, give up a dime, give up a quarter. Inside the paper trading app, I'm just going to buy it. So I'm going to put it in. Let's see if we could get, I guess I'll put it in a little bit lower here. 31.35. We're buying 2 of them. Let's put it in at 32.05, just over 32. Let's send that to the floor, see where that one ends up at. And we're going to go to the orders mask here. The order is opened and it is pending. And I'm not getting to the order mask. Okay, so with that said, there it is. There it is. And we had some IBKR that we're looking to open today too. But here's our Nucor trade. Here is our Berkshire Hathaway trade. It filled today, so this one is still open. And these are our portfolio of stocks that we have. We have JP Morgan is a deep in the money option that's sold off a little bit. We got the 290 call. We're down a little bit on that position, but it's been very volatile within this space. We've been up and down and sold some calls, already rolled that a couple of times. And then we have a deep in the money option contract on Meta, and we've sold the 720 call on Meta on that position. And then we go down to NVIDIA, and we have this position on where we are on the 160 call option, and we've done pretty well on Walmart. The Meta position, we're going to have to adjust. We'll probably either close this trade out. We sold this for 14, bought it back for 158, and we're down 5 on it. So we're up a bit, a good amount on our 720. We hit that on the upside. We'll probably roll this call because I want to stay in this position. So when we come back on Wednesday, we're going to do some adjustments to this. This has already gone below our strike. Where's Meta right now? 648, and we're at 700. So we broke our rule. We need to get out of this trade. And if anything, we just need to roll it. So I think we close that whole position and we roll it out. And that's what we're going to do on Wednesday's show of next week. So we got 2 new orders in. Nucor, it's not letting me. It's not filling it. It's not being nice. Let's go 3250. There we go. We'll replace that. Hopefully that will get filled. And that's it for this President's Day edition of Options Guy TV. We'll be back on Wednesday, 11 a.m. Eastern time. We'll look to make our adjustment in Meta, and we'll see how our positions are doing in Nucor and also in Berkshire Hathaway. Thanks for tuning in. See you Wednesday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.